Goldman Sachs has stunned people with a bearish outlook for US stocks. They think that over the next decade, US stocks will underperform government bonds. In this video, we'll look at why they came up with this shocking forecast, who agrees with them, the counter-argument, and what to do if you do agree with them. I'll finish by giving you my view. This video is sponsored by Trading 212, the UK commission-free investment platform. Let's begin with that controversial forecast from Goldman Sachs. Based on a statistical model of US stock returns, they think that the S&P 500 will generate 3% return, a little bit over 3.1%, over the next decade, compared with a group of 21 investment banks and asset managers whose forecast averages 6%. Goldman's forecast is very low indeed. This number comes as a shock as I make this video because for the last decade, from 2014 to 2024, the S&P 500 has generated 13% total return when you annualize the percentage. And that's above the 11% per year that we've seen since 1930. So it's been a very good run. So if we look at every 10-year rolling return for the S&P 500 over the last century, that's what you can see in this graph. You can also see the Goldman forecast in green, and you can also see the distribution for the other forecasters in dark blue. Notice how both the other forecasters and Goldman have revised down their forecast based on the very high valuation of US stocks. So it's not just Goldman that's bearish here, it's just the degree of bearishness which varies between Goldman and its peers. Goldman's revised down its forecast by 3/4 compared to the average, whereas other forecasters have halved the average return for the S&P. So where does all this bearishness come from? Well, it's based on Goldman Sachs' model, which has 5 inputs. Several of those inputs are close to their most extreme values over the last century. For example, the US market is concentrated in the shares of a handful of huge companies, the Magnificent Seven. Return on equity, a measure of efficiency for profit generation, is also as high as it's ever been. And largely as a result of the expensive Magnificent Seven stocks, valuation is close to a record high. But it's not all negative, as the US economy is strong and interest rates aren't particularly high compared to the last century. But concentration is the greatest problem, according to Goldman. The 10 largest stocks make up 1/3 of the S&P 500. That's the highest top 10 concentration since at least 1980. Goldman's model uses this concentration measure, which is the market cap of the largest stock, currently Apple, relative to the 75th percentile stock. So if you rank all of the stocks in the S&P 500 from largest to smallest, it'll be the size of Apple's market cap relative to the 75th percentile stock. Now this measure shows exceptional concentration. Their forecast would be a huge 4 percentage points greater, i.e. 7% per year rather than 3% for the S&P, if they'd exclude this variable for market concentration. And that's because this concentration variable ranks near the highest level in a century. Now this isn't like 2000 when we had a lot of concentration in unprofitable tech stocks. The Magnificent Seven are hugely successful and profitable companies with rapid earnings growth and high margins. History shows, however, that maintaining blistering rates of sales growth for a decade is extremely unlikely. For example, if you look at companies which generate 20% sales growth or greater, that's certainly possible, but only 1 in 10 companies in the S&P manages that consecutively for 5 years or longer. Similarly, keeping margins above 50% for several years is very unlikely, as competition inevitably eats away profitability and pricing power. The upshot is that unless new companies become magnificent, this is going to be a problem for the overpriced US stock leaders, as earnings disappointment or antitrust legislation may end their bull run. Let's not forget valuation. You've probably seen me use these graphs before, which plot the CAPE measure, Robert Shiller cyclically adjusted price to earnings ratio, and that looks at the price of the S&P 500 relative to the profits generated by the companies in the index over the previous decade. It's a very good bubble indicator. Currently, the US stock market, by almost any measure, is looking expensive. CAPE is no exception, with a 38 times multiple. So if we read across to forward returns, this suggests a measly 4% return over the following decade. And so we come to the controversial comparison with US Treasuries. According to Goldman's model, the chance of US stocks underperforming US Treasuries is about 3/4. Goldman says that boring old Treasuries will outperform the most successful stock market in the world over the last decade at least. There's even a high probability, 1 in 3, that the S&P 500 will have negative real returns over the following decade, so investing in stocks would make you poorer. Now, if we exclude concentration as one of the inputs to the model, those probabilities would be far lower. So the chance of underperforming treasuries would be just 7% instead of 3/4, and the chance for no real return would fall from 1/3 to just 1%. So the real clincher for Goldman at least is concentration. Now in a moment we'll see that it isn't just Goldman who has a bearish outlook. Today's video is sponsored by Trading212, a UK commission-free investment platform, which I've been using for some time for my fund portfolio. For example, I've got a UK small cap portfolio with 12 stocks in it, which I have as a pie. That means that I can rebalance that portfolio, my pie, with just one click. Also, I could auto fund it, so it encourages regular investing. And if I wanted to, I could copy other people's pies or publish my pies so that you can see what I'm doing. You can also copy pies created by professional fund managers. But just because it's low fee doesn't mean it's not innovative, far from it. Trading212 Invest, for example, is a multi-currency account that allows you to hold money and trade in multiple currencies. This means you no longer have to convert money and incur FX fees every time you trade in a different currency. There's also the 24/5 trading feature, and that means you can trade the US stocks available on Trading212 anytime you like. It includes 4 trading sessions, pre-market, regular hours, after hours and overnight. And of course you can still use fractional shares and the trading is commission free. Now viewers of PensionCraft have a special offer from Trading212. You can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, and then use my name as the promo code, which is Ramin, R-A-M-I-N, and you'll find a link to that offer in the description below. Now let's see what Vanguard has to say about this. And Vanguard too produces 10-year forecasts. And they also say that US equities will perform poorly, albeit not quite as poorly as Goldman. 3% would be at Vanguard's lower forecast range. So to quote from a Vanguard report, they said, in the second quarter, we saw a continuation of the story of lower long-term expected returns in the US equity market, due to high equity valuations within it and reasonable expected returns outside the United States. Our expected returns for stocks and bonds over the next 10 years are very close. The premium for taking equity risk is very narrow. Vanguard's model suggests that in the UK, where economic data are sort of okay, but valuations are relatively low, it's a very unloved market, have better upside, with return forecasts ranging from 5.2% to 7.2% over the coming decade. But here too, bond returns look reasonable, although significantly lower than for UK domestic stocks. However, there are dissenting voices. So what is the counter-argument? So here's Ed Yardeni. I often use his graphs. Thanks, Ed. And he argues that returns could be closer to 11%. Why is he so optimistic? Well, it's based on the US economy. He thinks it's going to grow at 3%, which is okay for the US, a developed market. And also we've seen inflation fall to much more reasonable levels. He expects it's going to carry on at 2%. He also points out that even the compounding of reinvested dividends would make 3% as a forecast for US stocks unlikely. Yardeni's argument focuses on concentration in tech stocks, and he thinks that's justified given their strong fundamentals, and he points out that it's not like the dot-com bubble. These are very productive companies. Productivity is in fact rising over time rather than declining, and that's driven by technological advancements. So if we look at the composition of the S&P 500 right now, there's a lot of concentration in those high productivity IT companies and communication services companies. They now make up a third combined of the S&P 500's earning power. Whereas if we compare that with the dot-com era, they only made up a quarter of the S&P 500's earning power. So Yardeni's overall forecast is incredibly bullish. He thinks this is going to be the roaring 20s. And he thinks that's going to be driven by technology-led productivity growth and really solid earnings and dividend growth in those sectors. So let's say you don't agree with Ed Yardeni and instead you side with Goldman Sachs. What can you do about it? Well, one suggestion from Goldman Sachs is that it may make sense to switch your US allocation towards small caps with an equal weighted S&P 500 index tracker. Now, these have underperformed US large caps for about a decade, and Goldman says that an evening out of performance would mean a massive 8 percentage points of outperformance for an equal weighted S&P 500 index tracker, and that's relative to a market cap weighted S&P index tracker. Incidentally, I have made a video about that called Equal Weight S&P 500, the Smart Investor's Choice, ? With a link in the description. Alternatively, you could hold both a market cap weighted S&P tracker alongside a small cap index tracker for the US. You can see several of those here alongside me, and this is from Just ETF. Personally, I've gone for the one at the top in my fund portfolio because it tracks the S&P 600 index and that filters for quality. For example, it excludes unprofitable companies, and of course, it also has a very low expense ratio. Alternatively, you could split your geographic exposure according to region. So instead of just one global index fund, you have one for the US, Europe, Japan, EM. The overall fee for those funds would be very low, around 9 basis points, 0.09%, and it gives you the flexibility to dial down your US allocation if you think it'll underperform. All I'd say is don't dial it down too much. Betting against the US is usually a bad idea. And then finally, you could just de-risk your portfolio. So take money out of your global index funds, say, and put them into government bonds or maybe money market funds, and then hope that a correction happens and you can buy back in at a lower price. However, this is usually a mistake because if you have time out of the market, the equity market, usually it leads to underperformance. Finally, what do I think? Well, firstly, it's hard to argue with Goldman's data. Valuations in the US are very high again, and it is a very concentrated market historically. Now, it's possible that AI will be completely transformative and allow huge earnings growth, and that this is just the beginning of that transformation. However, we've heard that so many times before, and it's always been wrong in the past. Eventually, these trends implode. So I'm certainly considering adjusting my core portfolio to tilt away from the expensive mega cap US tech stocks. But at the moment, I'm not convinced enough to complicate my one fund allocation. Simplicity, giving it up, comes with a huge price. Now don't forget our offer from Trading 212 to claim free fractional shares worth up to £100. Open an account, verify it, fund it, and use my name as the promo code RAMIN, RAMIN, and you'll find a link to that offer in the description below. And, as always, thank you for listening.